Hello everyone, I am Dr. Soundararaj. I am going to discuss with you a problem related to funds flow statement in this video. I have already released a few videos on the same topic but with different models of problems. Kindly watch those videos also to gain a better understanding of funds flow statement and calculation of funds from operations as well. The links for those videos are given in the description of this video. Kindly access those links and watch those videos also. These are all a few details about me related to my career. After watching the video, if you really like the video, give a like to the video and do subscribe my channel as well. Let's get into the problem. The following are the summarized balance sheets of ITC Limited as of 31st March 1999 and 2000. You are given with the balance sheets for these 2 years separately. The first balance sheet is related to the previous year 1999. You are given with the share capital, general reserve, profit and loss account, sundry creditor. Sundry creditor is a current liability which would be taken over to the schedule of changes in working capital. Provision for taxation. We will open a ledger account for provision for taxation, fixed assets, investments, stock, sundry debtors, bank. Stock, sundry debtors and banks are current assets. These will also be taken over to the schedule of changes in working capital to learn what change has been taking place in the working capital during the current year comparing that of the previous year. Now the second one, you are given with the balance sheet for the current year. Here in the problem it is 2000. Share capital is given. There is no change in the share capital comparing that of the previous year. General reserve, you find 10,000 rupees increase in general reserve, which would be a non-fund, non-operating item debited in the adjusted P&L account. P&L account closing balance is given. Mortgage loan, a new item, a long-term liability is given, amounted 2,70,000, which is a source of fund to be recorded in the funds flow statement. Last year there was no mortgage of loan, only this year it is available. So the entire amount has been mobilized through the long-term liability, mortgage loan. Sundry creditor is given here. There is a decrease in sundry creditor comparing the amount of sundry creditor of the last year. Decrease in the current liability leads to increase in working capital. Provision for taxation, 10,000 rupees is given. It will be taken over to the provision for taxation ledger account. Then regarding fixed assets, you find decrease in the value of fixed assets comparing that of last year. We will open ledger account and find out what is going to happen. Investments, increase in investment amounted 10,000 given here. We will decide what is the reason for it and what else have happened in relation to investment after going through the additional information of the problem. Stock, decrease in stock, decrease in the current asset leads to a decrease in working capital. Sundry debtors, increase in sundry debtors, increase in the current asset leads to increase in working capital. Bank, you find increase in bank balance. So increase in the current asset leads to increase in working capital. So these aspects you consider in the schedule of changes in working capital and find out what change has been taken place in the amount of working capital during the current year 2000 comparing that of the previous year 1999. Let's look at the additional information. Investment costing 8,000 rupees were sold during the year for 8,500 and further investments were purchased during the year amounted for 18,000. So they have sold out an investment costing 8,000 for 8,500. Therefore they have earned a profit of 500 rupees, which is a non-operating income and that has to be credited in the adjusted P&L account, the 500 rupees. Whereas the whole sale proceeds of investment 8,500 is a source of fund which would be taken over to the funds flow statement. Fine, look at the balance of investment. In the beginning it was 50,000. From 50,000 you deduct the cost of the investment sold 8,000. So the expected closing balance should be 42,000. In addition to that, they have purchased investment for 18,000. So 42,000 plus 18,000, the new expected closing balance in the investment comes to 60,000. That is the figure available in investment also. So you don't require to open ledger account because there may not be any hidden information with regard to investments. Net profit for the year was 62,000 after charging depreciation on fixed assets 70,000 and provision for taxation 10,000. After you find the opening and closing balances of P&L account given in the balance sheet of the company, you don't have to worry about the net profit given in the additional information. But consider what has been recorded or what has been adjusted against the net profit. The first one, they have provided depreciation of 70,000 rupees on fixed assets, which is a non-fund expenditure, has to be reversed in adjusted P&L account. This would also be recorded in the fixed assets ledger account. Then regarding provision for taxation, they have made a provision of 10,000 rupees towards taxation this year. It will be taken over to the provision for taxation ledger account and recorded with the journal entry of adjusted P&L account debtor to provision for taxation. Why do I credit provision for taxation in the journal? Provision for taxation is a credit balance basically. If new amount comes into the account, it is going to increase its balance. If you want to increase the balance of a ledger or an item with the credit balance, you further credit it. That's an idea. So adjusted P&L account debtor 10,000 to provision for taxation 10,000. And this would be taken over to two places. One, adjusted P&L account because it is a non-operating expenditure, a non-fund expenditure as well because it's only a provision. It will also be recorded in the provision for taxation account. The third additional information says during the year part of fixed assets costing 10,000 rupees was disposed for 12,000. So they have sold a fixed asset costing 10,000 for 12,000. So they have earned a profit of 2,000. The profit is included in the profit and loss account. So therefore this is a non-operating income and the 2,000 rupees profit earned by disposing a part of fixed asset has to be reversed. Therefore, it has to be credited in the adjusted P&L account. Dividend paid during the year amounted 40,000. First, dividend has to be proposed and that has to be recorded in the adjusted P&L account because this is a non-operating expenditure. And followed by the proposed dividend has been paid during the year. Since it is an application of fund, it would be taken over to the funds flow statement also. Now you can very well understand the preparation of schedule of changes in working capital with the support of the four formulae. However, I help you to recall those four formula. 1. Increase in current asset leads to increase in working capital. Decrease in current asset leads to decrease in working capital. Increase in the current liability leads to decrease in working capital. Decrease in current liability leads to increase in working capital. So keeping in mind the four formula, they have prepared the schedule of changes in working capital and the resultant figure of this particular schedule is increase in working capital amounted 2,97,000. Increase in working capital is also an application of funds which would be taken over to the funds flow statement and written under the application side if you prepare the funds flow statement under T format. That is what they have done here. See the increase in working capital. Okay, let's quickly get into the ledger accounts one after other. First one, they have prepared fixed assets account. Opening balance is written in the debit side because it is an asset which will have debit balance always, and the closing balance is written in the credit side. And we were informed that they have provided depreciation amounted 70,000 on fixed assets this year. I already explained the journal entry. Adjusted P&L account debtor or depreciation debtor, within bracket we can write adjusted P&L account to fixed assets. When you credit fixed assets, its value will come down because it's an asset. Fine. Then they have sold a part of the fixed asset costing 10,000 for 12,000 rupees. Let's first pass journal entry for selling the investment. Cash account debtor to fixed asset account 12,000. Now in the second journal entry, you separate the profit element of 2,000 there. Fixed assets account debtor to adjusted P&L account 2,000. Now investment account is open. Opening balance as usual, it is written in the debit side because it is an asset. Closing is written in the credit side. Now they have sold an investment costing 8,000 for 8,500. So the journal entry, Cash account debtor to investment 8,500, 8,500. Now the profit element of 500 has to be separated, passing another entry, investment account debtor to adjusted P&L account 500, 500. They have also purchased an additional investment for 18,000 rupees, that is also recorded here. What is the journal entry for buying additional investment? Investment account debtor to cash account. Debit what comes in, credit what goes out. So now the account is tallied, so absolutely no problem with regard to investment. Provision for taxation account, this is being a credit balance. The opening is written in the credit side, closing is written in the debit side. Now in the current year they have made a provision of 10,000 rupees for taxation. What is the journal entry? Adjusted P&L account debtor to provision for taxation 10,000, 10,000. Now 75,000 is the opening balance. 10,000 is a new amount added. So the closing is supposed to be 85,000 if nothing else has been carried out. But the closing, actual closing is only 10,000. What about the missing 75,000? It is the amount of tax the company would have paid during this year. So the journal entry, provision for taxation account debtor to cash account. Finally, they open adjusted P&L account. The opening balance of the account is written in the credit side, closing balance is written in the debit side. Now, whatever you found in relation to adjusted P&L account in the ledgers, you have already prepared should be transferred. Adjusted P&L account debtor to fixed asset account, fixed asset account debtor to adjusted P&L account is 2,000. Then investment account debtor to adjusted P&L account, the profit on sale of investment. Then adjusted P&L account debtor to provision for taxation. This is for the amount of provision for taxation made this year. All these are recorded. See in the credit side, by fixed assets, that's a profit on sale. By investment, that's a profit on sale of investment. Come to the debit side. This is for the depreciation provided on fixed assets. And this is for the provision for tax made during this year. And this item, the dividend proposed during the year, should be debited in the P&L account that I already explained. That is what they have done. What is this new item? Before you close this ledger, you have to go and refer the liability side of the company's balance sheet. Here you find the two balance sheets given separately. So look at it carefully. See, capital, no issue at all. P&L account, we open ledger. Sundry creditor is a current liability. Provision for tax, we open a ledger. What is the only item we have not discussed so far? 3 lakh general reserve, it has become 3 lakh 10,000. Therefore, what you understand? There is a transfer of 10,000 rupees from P&L account to general reserve. So, the transfer to general reserve should be debited in the adjusted P&L account. Do you find any other item like goodwill, preliminary expenses in this problem? No. And look at the adjustments. First adjustment is already channelized through investment account. Second one is channelized through fixed assets account as well as provision for taxation account. Then the third one is related to sale of fixed assets. The profit is also, we have discussed, so it is also channelized through fixed asset account. The dividend proposed is already recorded in the fixed asset account. It is recorded in the adjusted P&L account. It will also be taken over to the funds flow statement and recorded under application of funds. Now please have a look at the items one after other here in the adjusted P&L account. See, the general reserve is also discussed. Now they have closed adjusted P&L account and calculated funds from operation amounted 1,39,500. Now come to the last statement, which is nothing but funds flow statement. Purchase of investment, we already discussed it. Payment of tax, we found through preparation of a provision for taxation account. Dividend has been paid, which was yearly proposed. Increase in working capital, this also we learned through the preparation of schedule of changes in working capital. Sale of fixed assets, source of fund, sale of investment, source of fund, mortgage loan raised during the year that I explained in the beginning of this video. Then funds from operation is also recorded. So the total of sources and application of funds comes to 4,30,000, 4,30,000. I hope you have understood all whatever I have explained in this video. Please watch this particular video a couple of times to have better understanding of funds flow statement. Thanks for watching this video. We will meet in another video related to funds flow statement. Have a happy learning, everyone.